Metallgesellschaft AG was one of Germany's oldest and largest industrial conglomerates. Founded in Frankfurt in 1881, it had interests spanning metals trading, mining, engineering, and chemicals. By the early 1990s, it employed roughly 58,000 people worldwide and was regarded as a pillar of German industry. Its U.S. subsidiary, MG Refining and Marketing, known as MGRM, handled oil trading and refining operations in North America and would become the center of one of the most studied derivatives disasters in financial history. Starting in 1992, MGRM developed an innovative product for U.S. energy buyers: long-term fixed-price supply contracts for gasoline, heating oil, and diesel. Independent gas stations and heating oil dealers could lock in a guaranteed delivery price for up to 10 years, shielding themselves against price spikes. The product was genuinely useful for customers who valued price certainty. By late 1993, MGRM had committed to deliver a total volume that economists later estimated at roughly 160 million barrels over those future years, a figure cited by Christopher Culp and Merton Miller in the Journal of Applied Corporate Finance. Those fixed-price commitments created a large and asymmetric exposure. If oil prices rose, MGR would be delivering oil at below market rates for years. The firm needed a hedge, a position that would gain value as oil prices rose, offsetting losses on the delivery obligations. The approach MGRM chose was to buy futures contracts on crude oil and oil products in the near-month market, in a quantity roughly equal to the entire long-term barrel commitment. This approach is called a stack hedge, and it placed MGRM among the largest participants in the U.S. futures market. The mechanics of the strategy worked as follows. MGRM bought near-month futures contracts for roughly the full volume it had promised customers over the coming years. Each month as those contracts expired, it would sell them and buy new near-month contracts, rolling the position forward. If oil prices rose, gains on the futures position would offset the rising cost of the delivery obligations. The strategy also carried a built-in assumption about market structure. It was designed to benefit from a condition known as backwardation. In a backwardated oil market, prices for contracts expiring soon are higher than prices for contracts expiring months or years later. When a trader rolls a stack from an expiring near-month contract into the next month, they sell at a higher price and buy at a lower one, earning what traders call roll yield. Oil markets had spent extended periods in backwardation historically, and MGRM's strategy was partly designed to capture that yield as an ongoing income stream. But backwardation is not a permanent state, and the strategy's cash structure left almost no buffer for the market to behave otherwise. In the second half of 1993, oil prices weakened considerably, falling from roughly $20 per barrel toward $14 to $15 by year-end. Simultaneously, the shape of the oil futures curve shifted. The market moved into contango, meaning near-month prices were now below longer-dated prices. Rolling the stack forward every month now cost money rather than generating income. MGRM was selling a lower-price near-month contract and buying a slightly higher price next month one. The roll yield the strategy depended on had turned negative, and the losses on the futures book were accumulating in real time. As oil prices fell, losses on MGRM's large long futures position triggered daily variation margin calls from the exchanges. The clearinghouses required cash deposits each day to cover mark-to-market losses. The long-term fixed-price delivery contracts with customers were, in theory, growing more valuable as oil prices fell below the locked-in delivery price, but that value was entirely unrealized. Customers would not receive deliveries or make offsetting payments for years. MGRM was paying cash out today against a gain it could not collect until later. Economists call this funding risk, and it is distinct from the question of whether the overall hedge was economically correct. By December 1993, MGRM had absorbed margin calls widely estimated to have exceeded $900 million. The German parent company's Supervisory Board, advised by outside counselors including Deutsche Bank, voted to terminate MGRM's energy operations and liquidate the entire futures position. Culp and Miller argued this decision was the actual catastrophe. The strategy was a legitimate long-term hedge, and the board, unfamiliar with derivatives, panicked and crystallized paper losses that time would have reversed. Franklin Edwards and Michael Cantor, writing in the Journal of Futures Markets, argued instead that the strategy carried structural funding flaws from the outset and that the scale of the position made a clean exit impossible regardless of timing. That debate has not been fully resolved among economists. With MGAG facing insolvency, a consortium of approximately 150 German banks assembled a rescue package reported at roughly 3.4 billion Deutschmarks, equivalent to nearly $2 billion at the time. Deutsche Bank and Dresdner Bank led the effort. The rescue kept Metallgesellschaft alive, but at severe cost. Chief executive Heinz Schimmelbusch and most of the management board were dismissed. The firm spent years restructuring, selling assets, and reducing its workforce. The MGRM energy business was closed entirely. The MG case became one of the most examined examples in the derivatives literature precisely because both sides of the argument are partially defensible. The Culp and Miller view holds that MGRM was economically hedged. Any loss on the futures position would eventually be offset by profits on the fixed price delivery contracts, and only the premature exit caused a real loss. The Edwards and Cantor view holds that a hedge requiring the company to survive a prolonged cash drain is incomplete by definition, and that the scale of the stack relative to normal market liquidity made rolling it cleanly each month a structural problem. Most risk management courses today teach the MG case as an illustration that funding risk and market risk are separate dimensions, both of which must be controlled. The MG collapse, together with the Orange County bankruptcy and the Barings failure that followed in 1994 and 1995, concentrated regulatory and industry attention on derivatives risk management. The Group of 30, an international financial body, had already published influential guidelines on derivatives practices in 1993. The MG case gave those guidelines practical urgency and accelerated adoption of stress testing, liquidity risk limits, and requirements that board members overseeing derivatives books understand what they are approving. The case also sharpened debate about whether mark-to-market accounting, by forcing recognition of near-term losses on long-term hedges, can pressure firms into economically damaging decisions. The central lesson of Metallgesellschaft applies well beyond corporate treasuries. A position can be correct over a long horizon and still destroy the holder in the near term if the cost of staying in exceeds available resources. Individual investors who use margin accounts, leveraged products, or strategies that require ongoing cash to maintain a position face a version of the same risk, being forced out at a loss because the cost of holding exceeded what was on hand. Historians and economists also draw a second lesson from MG. The people overseeing any strategy need to understand it well enough to distinguish a temporary drawdown from a structural failure, because the decision to exit is itself a consequential and often irreversible act.